So this is a pattern that we've actually become pretty familiar with here. Pressure on the big growth stocks and then cyclical value stocks doing well. That means the market kind of coming in your direction, and it's rewarded you in the last 6 months or so with this valuation leadership. But I wonder how it manifests right now in terms of your thinking on stock by stock level, how this plays into valuations and whether the opportunity is still there. Maybe you want to start with one of your picks, Lear, which I think is very emblematic, right? In the auto sector, great fundamentals, lots of earnings momentum, but also the valuation higher than it's been in a few years. So maybe take that one up.
Yeah, sure. And it's very important to get context on this. We're not going to buy any company at Oakmark that we cannot make a cash flow justification for why the current price is trading for, equal to what it's worth. We buy things at a big discount to what they're worth. If you look at the treasuries, they yield 1.6%. So, you can buy a bond for 60 times earnings and it doesn't grow. You look at the market, it's got a 20 PE for next year. So basically, that's a 5% cash flow yield, more or less. You look at a company like Lear, yes, it has done well, but this is a company, with an $11 billion market cap that is going to produce $1.5 billion of cash flow. It's a $200 stock that's going to have $21 of earnings in a couple of years. So although the stock price has done well, the cash flow that it produces for, one of the worldwide leaders in automotive seating, basically a part of the car that's not going anywhere, whether it's an EV or autonomous vehicle, we look at that and we say, look, that's a pretty good price, especially relative to the opportunity set.
And nothing in terms of the current production slowdowns and the chip shortages is knocking that off course?
Well, the second quarter is going to be worse than the first quarter in that regard. But generally speaking, when you look at the earnings that all of these companies reported in the past couple weeks, they cite the second quarter as probably the period of maximum tightness. So if you were to think about it as your family's business, you would say, okay, this is an issue right now, but in 2023, 2024, it should be solved. And that's where we're looking at the extreme cash flow imbalance relative to the current quote.
When I look at some of the holdings you have, obviously, and you had a very good first quarter in part, CBRE contributed to that. We had the CEO on with us last week after that quarter. But I know you also own Netflix, which sort of has gotten wrapped up here in the selling of some of these big growth stocks. What are your expectations there that leads you to want to continue to own that stock?
So if you're an individual investor and you're buying a stock, I would just always think to yourself, what's the cash flow characteristics of this business that justifies the current quote? And in the case of Netflix, obviously it trades at a high stated multiple, but this is a company that in the first quarter 2 years ago had 10% margins. The first quarter last year had 17% margins. First quarter this year has 27% margins. We look at it and we say, all right, this is a $500 stock. It's probably capable of producing $25 or $30 per share of earnings a few years out. It's got a monstrous moat around its position, along with a few of the other streaming services. It's investing a ton of money in content creation to widen the moat. So although it is lumped in with the growth companies, it has cash flow characteristics of all of the stocks that we own. Basically, you're paying essentially a market multiple in the out year for a company with wonderful strategic positioning.
Shepard Smith here. Thanks for watching CNBC on YouTube.